Warren Buffett once said something that shocked the world. I pay a lower tax rate than my secretary. How is that even possible? How can someone worth over $100 billion pay less in taxes than someone making $50,000 a year? The answer isn't illegal tax evasion. It's perfectly legal tax optimization strategies that the wealthy have been using for decades. And here's what might surprise you. Many of these strategies aren't just for billionaires. Some can be used by anyone making six figures or more. Today, I'm pulling back the curtain on exactly how the ultra-wealthy legally minimize their tax burden. We'll cover everything from the buy, borrow, die strategy that lets billionaires never pay capital gains taxes, to charitable giving tactics that actually increase their wealth while reducing taxes. But before we dive in, let me be crystal clear. Everything I'm sharing today is completely legal. These are strategies written into the tax code, often by design. However, tax laws are complex and change frequently. So always consult with a qualified tax professional before implementing any of these strategies. Now hit that subscribe button, because understanding how money really works is the first step to building serious wealth. Strategy 1. The buy, borrow, die method. Let's start with the most powerful wealth preservation strategy ever created, the buy, borrow, die method. This is how Jeff Bezos, Elon Musk, and other billionaires live lavish lifestyles while paying almost nothing in income taxes. Here's how it works. Instead of selling their appreciated stocks and paying capital gains taxes, wealthy individuals borrow against their stock holdings. Banks are happy to lend them money at low interest rates because the loans are secured by billions in assets. Let me break this down with a real example. Say Elon Musk wants to buy a $100 million mansion. Instead of selling Tesla stock and paying 20% capital gains tax, that's $20 million to the IRS, he borrows $100 million using his Tesla shares as collateral. The loan isn't taxable income, so he pays zero taxes on that $100 million. But here's where it gets even better. While he's paying maybe 2 to 3% interest on the loan, his Tesla stock continues growing at potentially 10 to 20% annually. So he's borrowing at 3% against assets growing at 15%. That's a 12% annual arbitrage. When he dies, his heirs receive what's called a stepped-up basis. This means if he bought Tesla stock at $10 per share and it's worth $1,000 per share when he dies, his heirs inherit it at the $1,000 value. They can then sell enough stock to pay off the loans and never pay capital gains taxes on that $990 per share appreciation. This strategy lets billionaires live off borrowed money their entire lives and pass wealth to the next generation without ever paying capital gains taxes. It's completely legal and saves them hundreds of millions in taxes. Strategy 2. Charitable remainder trusts. Here's a strategy that sounds too good to be true, but is written right into the tax code. Charitable remainder trusts, or CRTs. This lets wealthy individuals donate appreciated assets to charity, get a massive tax deduction, continue receiving income from those assets, and still pass wealth to their heirs. Let me explain with a concrete example. Sarah owns $10 million in Apple stock that she bought for $1 million years ago. If she sells it, she'd owe $1.8 million in capital gains taxes. Instead, she donates the stock to a charitable remainder trust. Here's what happens next. First, she gets an immediate tax deduction of approximately $3 million, saving her over $1 million in income taxes. Second, the trust sells the Apple stock tax-free. No capital gains taxes owed. Third, the trust invests the full $10 million and pays Sarah 5% annually for life. That's $500,000 per year. But wait, there's more. Sarah uses part of her tax savings to buy a $3 million life insurance policy with her children as beneficiaries. When she dies, the remaining trust assets go to charity, but her kids receive $3 million tax-free from the life insurance. So let's recap. Sarah avoided $1.8 million in capital gains taxes, saved over $1 million in income taxes, receives $500,000 annually for life, supports charity, and still passes $3 million to her children. That's the power of advanced tax planning. Strategy 3, family limited partnerships. Family limited partnerships, or FLPs, are incredibly powerful tools for transferring wealth while minimizing gift and estate taxes. Here's how wealthy families use them to pass billions to the next generation. The parents contribute assets like real estate, business interests, or investment portfolios to the partnership. They retain control as general partners while gifting limited partnership interests to their children. The key advantage is valuation discounts. Because the children receive non-controlling interests in a partnership, those interests are worth less than their proportional share of the underlying assets. Courts have approved discounts of 20% to 40% for lack of control and marketability. Here's a real example. The Johnson family owns a $50 million real estate portfolio. They contribute it to a family limited partnership and gift 40% limited partnership interests to their 3 children. Due to valuation discounts, those 40% interests might be valued at only $15 million instead of $20 million for gift tax purposes. This saves them $5 million in gift tax value, and all future appreciation on those assets happens outside their taxable estate. If the real estate doubles in value over 20 years, that's an additional $20 million transferred to the next generation without additional gift or estate taxes. The parents maintain control as general partners, can dictate distributions, and often continue living in family properties. It's wealth transfer with strings attached. Strategy 4, opportunity zones. Opportunity zones are one of the most powerful tax incentives created in recent history, and wealthy investors are using them to eliminate capital gains taxes entirely while building generational wealth. Here's how it works. If you have capital gains from any source, stocks, real estate, business sales, you can invest those gains in qualified opportunity zone funds. You get 3 major tax benefits. First, you defer paying capital gains taxes until 2026, or until you sell the opportunity zone investment, whichever comes first. Second, if you hold the investment for 5 years, you get a 10% reduction in your original capital gains tax. Hold it for 7 years and you get a 15% reduction. But here's the big one. If you hold the opportunity zone investment for 10 years, you pay 0 capital gains taxes on any appreciation from that investment. Let me show you the power of this with numbers. Say you sold a business for $5 million and owe $1 million in capital gains taxes. Instead of paying the IRS, you invest that $1 million in an opportunity zone fund developing affordable housing. 10 years later, your investment is worth $3 million. You can sell it and pay 0 taxes on that $2 million gain. You've turned what would have been a $1 million tax bill into a $3 million investment, and the $2 million profit is completely tax-free. Wealthy investors are moving hundreds of millions into opportunity zones, getting incredible tax benefits while investing in underserved communities. It's win-win tax policy in action. Strategy 5. Business ownership and deductions. Here's something most people don't understand. The tax code is fundamentally different for business owners versus employees. While employees pay taxes first and live on what's left, business owners deduct expenses first and pay taxes on what remains. Wealthy individuals structure their lives around business ownership to maximize deductions. That vacation to Hawaii? It's a business trip, if they attend a conference or meet with clients. The home office, business meals, travel, even their Tesla if it's used for business. All tax deductible. But it goes deeper than simple deductions. Business owners can use strategies like Section 199A deductions, which allow up to 20% of qualified business income to be tax-free. On a $1 million business profit, that's $200,000 in tax-free income. Defined benefit pension plans that allow business owners to contribute and deduct up to $230,000 annually for retirement, far more than traditional 401k limits. Equipment depreciation that lets them write off business purchases immediately rather than over several years. Augusta rules strategies where they rent their homes to their businesses for up to 14 days annually, creating tax-free rental income. The key insight is that wealthy individuals don't just own businesses for the income, they own them for the tax advantages that come with business ownership. Strategy 6. International tax planning. Wealthy individuals and corporations use international structures to legally minimize their global tax burden. While this gets complicated quickly, the basic concepts are straightforward. Many wealthy Americans establish residency in countries with favorable tax treaties or no capital gains taxes. Countries like Singapore, Switzerland, or certain Caribbean nations offer significant tax advantages for high net worth individuals. Corporations use transfer pricing to shift profits to low tax jurisdictions. Google, Apple, and Amazon have famously used structures like the double Irish with a Dutch sandwich to reduce their effective tax rates to single digits. For individuals, foreign trusts can provide significant benefits. While US citizens are taxed on worldwide income, proper international planning can defer or minimize taxes on foreign investments and business activities. Private placement life insurance, domiciled in favorable jurisdictions, can provide tax-free growth and tax-free access to cash values while maintaining privacy and asset protection. These strategies require expert guidance and significant resources, but they're how multinational corporations and ultra-wealthy individuals optimize their global tax burden. Strategy 7. Timing and deferral strategies. Finally, wealthy individuals master the timing of income and deductions to minimize their tax liability. This includes strategies like tax loss harvesting, where they sell losing investments to offset gains from winners, potentially saving thousands in capital gains taxes annually. Income deferral through deferred compensation plans, stock options, and installment sales that spread tax liability over multiple years. Charitable timing strategies, where they bunch deductions in high income years and take standard deductions in low income years. Roth conversion strategies during market downturns or low-income years to move money from tax-deferred to tax-free accounts at optimal times. The wealthy understand that when you pay taxes matters almost as much as how much you pay. Strategic timing can save hundreds of thousands over a lifetime. These strategies reveal a fundamental truth about our tax system. It's not just about how much you make, but how you make it, when you receive it, and how you structure your financial life around it. The ultra-wealthy aren't breaking the law. They're using the tax code exactly as it was written. Many of these strategies were intentionally created by Congress to incentive certain behaviors, like charitable giving, business investment, and community development. While not everyone can implement every strategy I've discussed today, understanding how the wealthy think about taxes can inform your own financial planning. Whether it's maximizing your 401k contributions, starting a side business for the deductions, or working with a tax professional to optimize your situation, everyone can benefit from strategic tax planning. The key takeaway is this: taxes are your largest lifetime expense. potentially costing you millions over your career. Investing in proper tax planning and professional advice isn't an expense. It's one of the highest return investments you can make. What surprised you most about these strategies? Let me know in the comments below. And if this video opened your eyes to how taxes really work, hit that like button and subscribe for more content about building and preserving wealth. Remember, knowledge is power, but applied knowledge is wealth. Take what you've learned today and start having conversations with qualified professionals about optimizing your own tax situation.